Want to know how rich people pay zero taxes on capital gains legally? Well, in this video, I'm going to show you exactly how they do it and how you can too. But before we get started, I'm Dr. Jeff Anzalone, a dentist on a mission to get you to the point where work is optional. Do me a favor, download the free passive income training, links below this video. Let's get going. Now, before you can lower your taxes, you have to understand how they actually work, right? The truth is, most people, even high income earners making a lot of money like doctors and dentists, they have no idea, zero education on how the tax system really works. When it comes to taxes, there's only 3 types of income that matter. Crazy that they didn't teach us in school, but there's 3 types of income that matter. And if somebody tells you otherwise, they're wrong. So let's talk about what are the 3 types of income. Let's start off with the one that has the worst tax treatment. One that you're very, very familiar with, especially if you're a doctor or dentist, and that is your active income. Active income is what you earn from a job or your practice or running a business, or like me, running a dental practice. And I mentioned a little bit earlier, it's the worst tax treatment. It's taxed at the highest ordinary income rates. The highest ordinary income rates. And it includes an extra, as of this video, 15.3% for Social Security and Medicare. So high ordinary rates, and then 15.3% for Medicare and Social Security. Now, here's the thing. If you're self-employed like me, you pay the full amount, 15.3%. If you're an employee, you pay half of that and your employer pays the other half. Now, unfortunately, this type of income is what most people rely on to fund their lifestyle, their entire careers. And when we get out of training, get out of school, that's really the only type of income that we know, right? And one of the reasons this is bad is because this type of income involves our what? Our time. We have to trade it in order to get paid. Think about that. Seriously, I want you to take a step back and think about it. Think about how our entire education system, from the time you were in kindergarten till you got out of college, or if you did extra training like me, our entire education system is based on putting us through. Most of the time we get out with a lot of debt. So we get out, they're putting us in debt, and then they're shipping us off to a job where we spend the next 30 to 40 years paying off that debt and making active income and trading time for money. You ever thought about that? Quite eye-opening, right? Let me give you an example. If you make, let's say $100,000, even if you make just $100,000 a year, over $14,000 is going to go straight to Social Security and Medicare. Go straight to it. So even if people tell you, oh, you don't really pay much taxes or whatever, this or that, we get taxed and taxed and taxed. So just remember, your whole focus right now, if it's just active income, it's time to make a change. All right, let's move on to a type of income that gets a little bit better tax treatment, and that is what's called portfolio income. So what exactly is portfolio income? It's going to include interest. Well, you're like, Jeff, what do you mean by interest? So if you, let's say you loan money to somebody, an uncle or a friend or something like that, and they pay you back what you loan them plus a little bit of interest, that's a type of income. Next is royalties. If you create something like a book or software, something like that, you can earn royalties. So for example, Amazon pays me on a monthly basis. They pay me a monthly royalty for the books that I've written and I'm currently selling on their site. One that you're probably familiar with, dividends. If you own stocks like Apple, AT&T, Coca-Cola, these types of companies, these are dividend paying stocks. They pay a portion of their profits to you, the shareholder, in the form of a dividend. Dividends and long-term capital gains, dividends and long-term capital gains are treated much better than ordinary active income. So instead of being taxed at the highest rate, which is now over 37%, your portfolio income is taxed at either 0%, 15%, or 20%, much less than active income. And they're taxed based on this, based on your income. Now, if you hold an investment for over a year, it qualifies for long-term capital gains rate, which, as you know, can save you a lot of money. The short-term capital gains rate. Short-term capital gains are from assets that you hold less than a year. And if you sell something, you hold it less than a year, your income is going to be taxed as ordinary income. Now, one of the biggest advantages of Portfolio income is that, again, capital gains are taxed less, but something else pretty cool. Capital gains can be offset by something called capital losses. They don't teach you that in school, do they? Now, let's say you buy Tesla stock and you buy $30,000 worth of Tesla stock. For whatever reason, it goes down to $20,000. You get in a panic, you sell it. You just lost $10,000 on that stock. Now, you can actually use that loss, that $10,000 loss, to cancel out $10,000 gains from another investment. Make sure you get your accountant, your financial advisor, somebody like that involved. But you can do that because why? Capital gains can be offset by capital losses. Now, what if your losses, what if you have more losses than your gains? Well, the IRS actually lets you apply up to $3,000 per year of extra losses to lower your regular income tax. Any remaining losses, they're actually going to be carried forward, so you're not going to lose them, anything like that. Some other different types of strategies while we're talking about this is, one is called tax loss harvesting. So if an investment loses value, let's say you lose value in a stock, cryptocurrency, something like that. So if an investment loses value, you can actually sell it at a loss to offset your taxable gains. Then you can wait 30 days before buying it back to avoid something called the IRS wash sale rule. That's tax loss harvesting. Another way is the wealthy actually, they avoid taxes by they borrow. They never sell their assets. You'll always be hearing this. Warren Buffett always says you never sell anything. Why? Because they know that they can avoid taxes by borrowing against their assets instead of selling them. So you can actually use something called a subblock, a securities-backed line of credit, to access your cash without triggering capital gains. Because if you sell something, it's going to trigger their capital gains taxes. Instead, you can the wealthy borrow against that asset without triggering these taxes, and then just use that instead. One, if you're a real estate investor, one that you're probably familiar with is a 1031 exchange. So if you sell an investment property, you can actually reinvest the profit into another property and pay zero capital gains tax. Also, you can invest in opportunity zones. Reinvesting, so you sell something, you can reinvest capital gains into a government approved opportunity zone that can actually defer or even eliminate your tax bill over time. Now, these strategies are why the wealthy people, again, they pay little to no taxes on their investments. They don't sell, they borrow, they reinvest, and they use tax advantage strategies. Again, none of this were taught in school. If you use the same playbook as they do, you can keep more of what you earn. Moving on to the third, remember I told you there was 3 types of income? Moving on to the third, we'll actually put it over here. And it's my favorite type of income, which is what my whole YouTube channel is based on, and that's passive income. Why? Multiple reasons, but one of the reasons is it has the best tax treatment. Passive income is one of the most powerful ways to build your wealth while paying less in taxes. Again, if you look at some of the other videos that I have on my YouTube channel, you're quickly going to realize that I talk a lot about this income. There are 2 main types of passive income, and both can offer big tax benefits compared to your active income. I'm gonna put this in a different color. I'll label this A. The first one is rents, rental income. So if you own rental properties, the income that you earn from those rents, so for instance, my mobile home parks, is considered passive. This includes, you have single family homes, RV park rentals, mobile home park rentals, apartment buildings, commercial properties, things like that. Now, what's the big deal about rental income? Well, remember this right here? The Social Security and Medicare tax? Guess what? You don't have to pay it. There are no Social Security or Medicare taxes like you have to pay from your active income. Also, depreciation write-offs, or you can expense your property. These are ways that you can actually reduce this type of income, sometimes down to 0. What's cool about real estate is even though it appreciates or goes up in value, the IRS allows you to expense or depreciate it because of the wear and tear of the property. Again, they don't teach you that in school. Cash flow for rentals can provide steady long-term income without, remember this, we have to trade our time for money. Over here, first of the month, you collect your rents. So example, let's say you own a rental property that brings in $2,000 a month. You could be making $24,000 per year without having to work for it. If you have an outside manager, or a lot of these mobile home parks that we do is little to no management. You could be doing, you can make stuff like this is just an example. And thanks to real estate tax deductions, remember depreciation, you could literally pay zero to no taxes on that $24,000. The most absolute wealthiest people out there in the world, they have 96% of their income from portfolio income and passive income. Yet, what do most of us do? We only focus on growing our active income. That's it. So do you see why working smarter, not harder, is the key to building wealth? First type of passive income, rental income. The second type of passive income, business income, without material participation. So what this means is this is income from owning a business without actively working in it. Basically what that means. This means you can go out and you can invest in a business, but don't run it day by day. Well, how do you do that, Jeff? Well, perfect example is just being a silent partner in a business while others manage operations. You can go out and purchase another dental practice. You can go out and purchase a plumbing company, a laundromat, a pool cleaning company, anything like that. Just becoming a silent partner in it. You put up the capital while other manages operation. So you're not actively working in it. Investing in my favorite investment, real estate syndications, where the experts, the general partners, they handle the deals. Again, owning vending machines, car washes, laundromats that run with minimal involvement. Those are just some examples of business income. People with high income, doctors, dentists, business owners, attorneys, they often invest in passive businesses because you get these great tax benefits. So imagine that you invest 50 grand in a business that pays you $10,000 per year passively. Because you don't work in that business, it's taxed as passive income, which again, it means no Social Security and Medicare taxes. Passive income, as you can see now, is taxed much differently than your active income. But there's even a bigger secret, okay? Remember we talked about these capital gains and losses? Well, something similar to that as well. Passive losses can offset passive gains or passive income. If you own rental property and passive businesses, you can use losses from one investment to lower the taxes on another. And remember we talked about depreciation. Depreciation in real estate, that is your best friend. Real estate investors, they use something called cost segregation. So we have cost segregation plus bonus depreciation. I have plenty of videos on this if you want to learn more. I'm just going to give you the highlights here. When you combine these two together, they create massive tax write-offs. These strategies, they can turn a profitable business or rental into tax-free income streams. You see how I'm starting to go with these different things? Remember about you never have to sell. Remember we talked about that. The really, really rich people, they avoid taxes by borrowing against their assets instead of selling them. This allows them to what? They can access the cash without triggering, remember, that capital gains tax. And then when you die, when you pass away, you can pass down your wealth tax-free. Your heirs get what's called a step up in basis, meaning they can avoid capital gains taxes on previous appreciation of your properties. That is how generational wealth is built. Now, I hope you realize now, when we talked about this, that unlike what you're focused on now, your active income, which is all most people have, hope you realize that passive income gives you more control over your tax bill. Over here, there's not a whole lot you can do. Here, lots of things you can do. Portfolio income, that as well. The best tax advantages you can get, passive income. Now, if you want to keep more of what you earn, you want to start focusing on assets that generate passive income instead of just trading your time for money. In my case, trading time, trading patience. The wealthiest people out there don't rely on active income. You know somebody that's really wealthy, go ask them. They're not going to tell you, I am a doctor, I am a lawyer. They're going to tell you, I own this business, I own real estate. Ask them. They shift their earnings that they make to passive and portfolio income, which again, are taxed at the lowest rates and offer more legal tax breaks. Now, I mentioned a little bit earlier about my favorite real estate investment, real estate syndications, that is beginning to create more and more passive income over time for me. If you want to learn more about them, great. Check out this video.